Welcome back everyone, and in today's episode we're uncovering 6 stocks to buy in the month of June. Now before we go straight into that, we want to just understand what's going on with the wider market at the moment, and the S&P itself in just the last 5 days is looking very strong. Many companies, many industries looking nice into the green, which is actually a very good sign given that in the last 35 years this on record has been the best performance in the month. As we can see, 2025 up more than 6%. What makes this even more fascinating is you've probably heard of the saying sell in May and go away, and that isn't something hopefully you did this month. As we said, markets are looking very strong. On top of that, perhaps one that we can take note of, but in reality just as a bit of a pointer, is that June has typically been the third worst month this century for the S&P. Again, typically we would say not really to factor this into any of your investment decisions, but quite interesting to see, especially for May, the overall markets were performing very strong. And we get news from Jamie Dimon, who is the CEO of JP Morgan, the large US bank, who believes that it's only a matter of time before the US bond market is going to crack. It is under severe pressure, he says, from rising debt, and calls on Donald Trump to really sort this issue out. In fact, he goes as far as to say that China isn't America's largest threat, it is the enemy within, and is really putting the pressure on the administration to turn the situation around. Now, you would have thought we had some very good news just weeks ago where US and China came to the table and had a 90-day pause with their tariffs, which were ludicrously high, to really come together and settle on some figures, but it looks like that isn't the case. We have a tweet from Donald Trump just yesterday going on to say that 2 weeks ago China was in grave economic danger. The very high tariffs I set made it virtually impossible for China to trade into the US marketplace, which is by far number one in the world. He then says, we went in effect cold turkey with China, and it was devastating for them. Many factories closed, and there was, to put it mildly, civil unrest. I saw what was happening and didn't like it for them and not for us. So I made a fast deal with China in order to save them from what I thought was going to be a very bad situation, and I didn't want to see that happen. Now, he goes on to say that because of this deal, everything quickly stabilized and China got back to business as usual, taking all the credit himself and saying everybody was happy, and that is in effect the good news element. He then says the bad news is that China, perhaps not surprisingly to some, bit of a low blow, has totally violated its agreement with us. So much for being Mr. Nice Guy. Putting it in short, effectively negotiations don't look to be going as planned, and we can see from the article from the Financial Times, it's saying that talks now have stalled, and this is 2 weeks after reaching a deal. What does this mean? Well, more volatility expected in the market. Uncertainty, as we always say, isn't something the global markets want to see, so do expect a bit of a bumpy ride, at least in the shorter term, and perhaps something that's really got Donald Trump's back against the wall, making him feel like the world perhaps isn't seeing him in a light that he would like to see, is that there's this term taco. Maybe you would know this reference in terms of the actual food, but it's actually short, as we can see here, for Trump always chickens out, a term that was coined, as we can see, by an analyst and was actually put towards Donald Trump just last week, and we can see here he said that he's never heard of this phrase and that he believes this is an incredibly nasty question. So we can see the heat is now ramping up, and one thing Donald Trump doesn't like is when people start to make fun of him, so again do expect perhaps, as we said, a lot more volatility. We also heard today from the Pentagon chief where there is a warn of imminent Chinese threat. Again, whether or not there is anything really substantial to take note of here, it will just add to the volatility. So in terms of where we go right now in terms of these issues with US and China, we can see they're planning to increase some of the tech sanctions that are already in play, and they're looking to add some new regulations, which in effect something we've already seen with some semiconductors, requiring licensing, whether that's new or just additionals to what are already in place, and that some of the companies that are going to be hit the hardest by this are some of the biggest semiconductor design and fabrication firms, and you do have to start to believe that if these things don't start to settle very soon, China in one way or another are going to retaliate with tariffs, as we saw from them not that long ago where they were increasing their rates into the triple digits. And one figure who believes all of these tariff tensions give no benefit to the US at all is Nvidia, where he ultimately says that the US chip controls have actually backfired and that one way or another China are going to have artificial intelligence, and their development, as we can note here, is already accelerating. Now the message the CEO Jensen Huang is really trying to say here is that the world is going to be developing, adopting technology, whether or not it is from the US. It is ultimately going to be beneficial to the United States if they are one of the main key players. We also saw the inflation rate drop to 2.1%. That is incredibly low when you just think about where this figure's been over the last few years. And now it is expected the Fed, based on these figures, especially as they were lower than expected, should now be in a position to cut. But that isn't what we're hearing from the Federal Reserve, as they're getting worried that these tariffs ultimately are going to increase inflation. We're going to see it ramp up again. And we see that Donald Trump had a meeting with Jerome Powell talking about the interest rates, and he believes he's making a very large mistake by not implementing any cuts. And this is something he also lashed out at him when we had a look at some of his tweets from just weeks ago, where he did put Jerome Powell and the Fed in not a very favorable light. Now, we did end the week with investor sentiment sitting in green, and this is something, as we always say, can change, and very rapidly. We're talking in a matter of minutes, especially with some of the tweets that Donald Trump has been putting out in just the last few months. And we would also go as far as to say that at the moment it is very hard to identify any significantly attractively valued companies, given that many of them are trading at some very stretched valuations. So today we're going to uncover 6 that we do believe are at some very good opportunities. But just before we do that, we want to let you know we have released our latest free weekly article. We drop one every single Monday morning directly to your inbox, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below and you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month, including the upside that Wall Street themselves see over the next year. We will be releasing June's copy in a matter of days, so as we said, make sure you are signed up. And on top of that, you can grab a recently released spreadsheet of 19 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We then move on to the first stock that we want to discuss today. These are all high quality companies. Firstly, we have S&P Global. Now, this is one that is actually trading at around $490. It was down after market hours by around 4%. And over the last year, it has performed very strongly, up 22%. Year to date, it is up, although marginally, at 3%. And over the last 10 years, this one has massively outperformed the S&P, up 403%. Now, we will notice at $490, it will be trading around the midpoint of the 52-week range, one that Wall Street sees in very high light. They give this a strong buy rating, and Seeking Alpha also in agreement. This is one to consider in the portfolio. Now, if we look at the forward P, and with that price drop, it will be sitting around the 28 level. That is below the 5-year average of 30, in what we would say then an undervaluation signal. And we do notice the yield again will increase slightly, not that far off the 5-year. So based on dividend yield theory, we would say on this model alone, it is reasonably valued. But remember, we never look at any one model in pure isolation. We will also shortly run it through our own valuation process. Now, on this model, we have the blue tunnel, which signals the expected fair price. Nice to see it has been increasing over time. That is ultimately what you want to see, not something that is as typical as maybe one would expect. And right now, we sit towards the lower end of the blue tunnel, so you could argue reasonable signal / slight undervaluation, that this is a high quality company. Extremely rare to see it below that blue tunnel in extreme undervaluation. Again, just something to bear in mind. We can also see their earnings green right across the board. That is something we love to note. This signals over the next 4 quarters, they are anticipating growth to the EPS for every one, 100% track record as well, 4 out of 4 beats, and they're trading based on December 2026 numbers at a forward P around the 27 mark. Their growth also comes at a B-. Now, year-on-year revenue 13%, as well as forward looking around the 9 mark, well above the sector, which sits in the mid-single digit, although they are growing their top line at a slightly slower rate than they have done over the last 5 years, with EPS projected over the next 3 to 5 years to grow at 13%, well above the sector at 9.6%, but pretty much in line with their own historicals. Profitability looking strong at an A, gross margin 70%, well above the sector at 60%, pretty much in line with their historicals around the 70 mark, and bottom line net income 27%, again above the sector, but slightly below their own 5-year at 29.7%. This is also a company that not only generates a significant amount of cash from operations, 5.7 billion, given the sector sits at 158 million, but also one that continues to generate more and more cash as time goes on. As we can see, their own 5-year average a lot lower at 3.7 billion. Now, institutions do hold around 87% ownership. We see around 11 billion worth of selling in just the last 12 months, but we get nearly 50% more in terms of buying at 14 billion. And we also notice in Q1 more buying than selling. So clear and obvious to see institutions, for the large part, more bullish than bearish on S&P Global. Now, just before we do dive into our own valuation, we want to highlight these underlying metrics of the company, starting off with free cash flow per share. As always, we do tend to ignore the earnings data. Whilst you can see it on screen, it is susceptible to manipulation by management through accounting. So consistent growth over the longer term is what we want to see. Whilst it's not as consistent as we want, still growing in the right direction, expected to continue the upward trajectory over the next 12 months. We also get some very strong growth in terms of their top line, double digit every single year from 2020, and even before then, still fairly respectable, 14% in the most recent annual accounts, and we can see pretty much tripling their top line from 2015 to 2024. Now, you will notice some of their metrics will have slightly changed over the last few years, given they have made a recent acquisition in 2022. But before then, we do notice they were returning excess cash through those share buybacks. Now that we did see that acquisition, it did increase, but they are starting to slowly restart some of those buybacks. ROIC, typically 10% or more to give us faith management are able to effectively allocate their capital. Very strong pre-2022 in the mid-30s, and even though it did lower after the acquisition, it is starting to ramp back up, and as we said, ideally minimum 10%. It has also affected their margins, nonetheless still well above the minimum 12% that we want to see and increasing from 2022, and the same to be said on the free cash flow margin. This is definitely what we would call a very, very high quality company, and as we just saw, also a free cash flow machine. Now, net debt to EBITDA, very, very important metric where we want to see below 3 for the majority of companies. Number you see below, number of years it would take them to pay off all of their debt net of cash on hand, and this correlates to balance sheet strength, dividend safety, 1.44 on a trailing 12 month, anticipated to go lower over the next year. Definitely a sign of a fairly strong balance sheet, something we always want to see. Now we're going to discuss the intrinsic value where we have $554 derived from the DCF model. Now we'll show you how we got there with the free cash flow year on year. Most recent increase 56%, on average 82 year on year. Now moving forwards, we have used 10% here, but we're going to discuss the low, medium and high. As we can see, 10, 12, 14 respectively. Numbers here are subjective. You can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for S&P Global or any others. But first, let's start with 10%, where the discount rate sits at 8. We would say, in fact, 10% is very conservative. You then get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and get to the intrinsic price, 554. If you use 12%, we will show you again here for full transparency, it comes to 644, 31% upside. And for those that believe we should be going a lot higher, 746, 52%. Now we're going to show you on the lower and medium rate today the margin of safety that is obtainable. And remember, we always start on 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that in today's episode, a buy at 499, and then we keep going till it's near the current trading price, we're saying if you right now believe the free cash flow will grow at 10% moving forwards, you're getting between 10 to 15% in terms of a margin of safety. Wall Street themselves see it a lot higher over the next year, $590 upside of 20%. Now we'll also show you at the medium rate, which we do also believe is a fairly reasonable assumption to use. You are still getting an attractive margin of safety. As we keep on going today at that rate, in fact, you're not getting 25% just yet, but not that far off, sitting 20 to 25, leaning more towards 25% though, as we can note here, and Wall Street, as we said, 20% upside. Give us your thoughts though. First company, S&P Global, in our opinion, high quality, Do you agree? And is this one to consider this month? We then move on to the next company, which is Lam Research, down 12% over the last year. Year to date, it is however up around 12%, outperforming the S&P, also outperforming on a 10-year basis, up 868%. Trading towards the lower end of the 52-week range, a double buy from both Seeking Alpha as well as Wall Street, and we also notice the forward P as well as the yield aren't that far off their own 5-year average, so this in turn, solely based on this model, would be a reasonable valuation signal. And if we were to move to the blue tunnel, again great to see it increase over the longer term, we can in fact see it is sitting towards the lower end, again another reasonable signal, perhaps slight undervaluation, but very similar to S&P Global, this is one that is very rare to see it in a severe undervaluation phase. Not quite green right across the board, but nice to see 3 of the next 4 quarters anticipated to be growth, the next 2 to be double digit, 100% track record, trading on June 26 numbers at a forward P pretty much bang on 20. Now growth does leave a little bit to be desired if you look at the rating at D+, but year on year sits at 20%, forward looking at 2, that is quite a large drop, and bear in mind this industry is cyclical, so we may pick this up when analysing the company. Sector does sit in the mid-single digit, and we can see the 5-year average does look a little bit more consistent around the double-digit mark. Earnings per share is anticipated though to sit around 16% over the next 3 to 5 years, which is above both sector and their own 5-year in the 13 to 14 region. And profitability sits at an A+, gross margin 48%, slightly below the sector at 51%, but above their own historicals, and bottom line 27.2%, well above the sector and also above their own historicals, so we do get some efficiencies to the margins, whilst they do generate a lot of cash from operations at $4.5 billion, given their 5-year does sit lower at 3.91 and the sector significantly smaller in the millions at 113. Now institutions hold 85% ownership. They sold $3 billion over the last year, but just look at the buys, $51 billion, although the largest portion was in Q4 2024. Nonetheless, in Q1 still a lot more buying, pretty much twice in terms of comparing it against those shares sold, so still significantly bullish for institutions. And in terms of their underlying metrics, well, free cash flow per share pretty consistently increasing over the longer term, anticipated to continue the upward trend in terms of the next 12 months. Sales growth, this is where we do see cyclicality shining through the numbers. Some years very strong, in their most recent year down 14%, but on a trailing 12 month up 20%, and we also can highlight that when looking at it from a numerical basis. Nonetheless, they've still tripled their top line over the last 10 years, and what they've done on top of that, something we didn't see at least over the last 10 years for S&P Global, returning excess cash to those investor pockets, quite a large number of share buybacks on a fairly consistent basis. ROIC still looking very, very strong, above 12%, even given the cyclicality, 30% on a trailing 12 month. Margins also very good. Remember, high quality companies, not just increasing their top line revenue, margins as well, something we note from Lam Research, and they're also, as we said with S&P Global, as noted by the numbers, a free cash flow machine. Net debt to EBITDA, you'll probably find it very difficult to find a lot of companies that are as strong in terms of the balance sheet. Nearly 0 every single day. Importantly, 0 on a trailing 12 month, 0 over the next year, telling us for Lam Research it won't even take them 1 day to pay off all of their debt net of cash on hand. Now intrinsic value gets to $95, the average of the 4 models. Given the current price at $80, we will be getting a margin of safety at 10% by $85. As of today though, we see 15%. Wall Street themselves also see 15% upside over the next year, $92 price target. Lam Research, based on your thoughts, based on the underlying metrics, high quality, and is it a buy or at least one to be put on the watch list for the month of June? We then move on to United Health, which has been in the news very significantly in just the last few weeks. It's down 38% over the last year. Year to date, down 40%. In just the last month, they've lost 1/4 of their total market cap. And over the last 10 years, they still, although fairly marginally, have been outperforming the S&P, up 159. If you want to understand why they've been absolutely battered in just this month, do check out some of our in-depth dives. They're currently trading near their 52-week low with a double buy from both Seeking Alpha as well as Wall Street. And we see a double severe undervaluation signal. Forward P sitting at 12.9, not only below the 5-year rolling, but also one of the lowest is offered to shareholders in the period. And the same to be said for the yield, 2.8%. The highest they've offered is around the 3% level, so not far off that, but well above their rolling 5-year at 1.4. We also get that confirmation when we take a look at this model, although we do have to point out the blue tunnel has started to drop slightly. That in turn probably reflects the cut that they had to their guidance and then their suspension, but we still see disparity between the 2 points. This is severe undervaluation levels. Now, in terms of the earnings, they only anticipate one of the next 4 to be growth, with a 75% track record, missing their most recent one by 9 cents, yet they're trading on December 26 numbers at a forward P of 11.3. Growth not looking good, as we do note an F here, but when we compare it 8% to 9% year on year in forward looking, that is still above the sector comparison and only slightly below their own 5-year average, which sits around 1 or 2 percentage points higher. And in terms of their EPS, 7.1%. When we compare, sector is expected to grow a bit faster at 10.2 and their own 5-year even faster at 13.3. Profitability does look good though at an A+, gross margin 22%. Sector does sit a lot higher though at 60. However, one area they excel at is their bottom line 5.4 when you consider the sector as a whole burning through cash -2% and the cash they generate from operations, nice that it's positive, nice it's very large at 28.5 billion, given the sector, as we said, burning through cash -12 million. Now, institutions hold 88% ownership, where they've sold 36 billion over the last year, but again, they've been buying a lot more, nearly at that double rate, and we can see they've actually bought twice as much in the most recent quarter. Clear to see institutions still very bullish on United Health. And in terms of their underlying metrics, again, free cash flow per share increasing over the long term, anticipated to continue over the next 12 months. Sales growth very impressive as well. We're talking about a very steady company in terms of the numbers, and that's also reflected when we take a look at it from a numerical standpoint, more than twice over the last 10 years. Shares outstanding, not very consistent. Some years they do share buybacks, some years they don't. Hopefully, given the share price right now is looking severely undervalued, we will see them authorizing a very large share buyback program. ROIC pretty consistent as well in the mid-teens, absolutely no complaints here whatsoever. And whilst the margins on both accounts, specifically however the operating margin is below our preference, as we highlighted against the sector, it is still a lot better, especially their bottom line net income margin. And in terms of free cash flow, pretty much straddling around the 5% year on year. No complaints either with their net debt to EBITDA well below 3, again fairly consistent, 1.2 on a trailing 12 month, expected to increase although marginally to 1.34 over the next year. Now intrinsic value gets to $440 given the current share price, again another company with substantial numbers in terms of the MOS. At 30%, a buy at $308, not at $35 just yet, so we would say up to around $308, $309, you're getting 30% MOS. Wall Street, they do continue to revise their price targets, sometimes increasing it, sometimes decreasing it. On average, 382, 26% upside at least into 2026. In your own opinion, give us your thoughts about UNH, everything that has been surrounding the company in the recent period. Is it a good time to buy, maybe one to wait for now, or in fact one to consider dumping? We then move into the oil industry, and we have covered ExxonMobil not that long ago, so whilst we like that one too, we have switched it up and gone for Chevron Corporation. Down 14% over the last year. Year to date, down around 6%. And over the last 10, it is up 35%. But as we always say, 1, this doesn't include dividends reinvested. And 2, this is if you had bought 10 years ago from this point on. For example, if you bought the COVID lows, we can see the price in fact trading around the $60 mark. You would be up fairly significantly. And we do note, like majority of oil companies today, it is trading near their 52-week lows. However, both Seeking Alpha and Wall Street do consider this company a buy. In terms of the forward PE, we do see it sitting above the 5-year average, 17.7, 12.2. So based on this solely a potential overvaluation signal, but then we get an undervaluation one on the yield, 5% above the average at 4.2, and again another overvaluation signal when we do take a look, plus the expected price has been decreasing. That is why we always say never look at these models in pure isolation. And in a more positive tone, we can see they increased their dividend 5% just this year. Always great to see when it's above inflation at 4%, and we can see over the last 5 years 6.5, over the last 10 at least in line with inflation, But what's really fascinating about this company is they're a dividend aristocrat, 25 plus years of consecutively increasing the dividend, but they've also been paying a dividend for the last 113 years without a reduction. Now, this industry, very similar to the semiconductor space, is cyclical, as noted as well through the numbers. Only one of the next four to be growth with a 50% track record, although nice to see the most recent quarter was a beat, trading on 2026 numbers at a forward P of 14.4, and their growth does come in at a D+, as we said, cyclicality pretty much flat year on year and forward looking. Sector not that great, but a little bit better in the low single digit, and over the last 5 years they have been growing at a much faster rate. EPS anticipated to grow around the 7% mark. That is lower than the sector at 9.5%, but not that far off their own historicals of 7.2%. Profitability looking strong at an A+, gross margin 39%, below the sector at 44%, also below their 5-year at 42%. Bottom line, 8%, not that far off actually in terms of the sector, and also above their own 5-year of 6.8, a little bit of efficiencies, and they just generate a ton of cash from operations, around 30 billion, the same as they have done over the last 5 years, and well above the sector comparative at 516 million. Now, institutions hold around 72% ownership, while selling 11 billion. They've bought twice as much, 22, in the same time frame, whilst buying nearly 3 times as much in the most recent quarter, and this is one where institutions continue to be very bullish on. If you want to see the reversal of the trend, although fairly marginal in Q1 2024, you would have to go quite some way away to around Q3, where they sold twice as much as they did in fact buy. And in terms of the underlying metrics, you will see cyclicality throughout. There is no real consistency to the numbers. That applies not just to the free cash flow, also to the sales growth. Again, you can see that when we're looking at it from a numerical basis. ROIC though, at least over the last few years, it has been above the minimum 8% that we do want to note for oil producers like Chevron Corporation. And again, lots of cyclicality, operating margin, free cash flow margin, but most importantly, the net debt to EBITDA, as we've highlighted earlier, a very important metric, is looking strong around 0.6 on a trailing 12-month basis. Now, intrinsic value gets to $156, where you are getting a margin of safety of around 10% up to 141. At 15, not quite there yet. So for Chevron Corporation, sitting somewhere around 10 to 15%, with Wall Street themselves, $162 price target, 18% upside. Remember, you're also getting a fairly attractive yield of 5%, and this is a company that has been paying dividends for more than 100 years. We then move back into the semiconductor space with Applied Materials, down 28% over the last year. Year to date, down 4%, but over the last 10, massively outperforming the S&P, up 678%, trading near their 52-week low with another double buy from Seeking Alpha as well as Wall Street. And we notice the forward P sits below their 5-year average, the yield also sitting above, giving us here a double undervaluation signal. And we notice when we take a look at this model, blue tunnel is increasing, and it is sitting slightly at the lower end, if not slightly out, so a potential undervaluation signal here too. The earnings doesn't look too bad either, with 3 of the next 4 quarters to be growth, 100% historical track record, trading on October 26 at a forward valuation of 15.5. Now, their growth isn't the greatest at a D, year on year 6%, forward looking at 5, slightly below the sector, but actually quite significantly below how fast they've grown over the last 5 years at 13 and 9% respectively. With EPS anticipated to grow at 9%, this is where the ranking is really pulled down, given the sector sits at 14 and their own 5-year at 13. Profitability does sit at an A+, 48% gross margin, slightly below the sector at 51, but actually slightly above their 5-year at 47. Bottom line, 24%, well above the sector at 4, in line with their own historicals, and cash generated from operations, 7.5 billion, well above their own historicals, but look at that, the sector completely small in comparison at 115 million. Now, institutions hold around 81% ownership, 15 billion worth of selling, a little bit more buying at 17 billion, the same we can see in the most recent quarter, so institutions a little bit more bullish than they are bearish, and free cash flow does look fairly strong for a company that is in fact in a cyclical industry, but we do notice a drop anticipated over the next 12 months. Again, cyclicality showing through the sales growth in terms of the percentage increases, but this company has nearly tripled their top line over the last 10 years, whilst also being very, very aggressive in their share buybacks, one of the most aggressive we have seen on this channel, going from 1.2 billion 10 years ago to now sitting at 823. Their ROIC absolutely fantastic as well, well above 12%, sitting at 26 on a trailing 12-month basis. And their margins also very good on both accounts, operating and free cash flow. And really, in today's episode, we just want to be highlighting high quality companies, which we do believe they all do meet. Net debt to EBITDA also very good, 0 expected moving forwards, and on a trailing 12-month basis. Now, in terms of our intrinsic value, we get to $220. As we can see, the average of these three. Don't forget, you can always grab a copy of this model by clicking on the pinned comment below, running through your numbers, whether it's for AMAT or any others. But as we do keep on going, in fact, you can see you are getting a fairly respectable MOS, near 30% at $154. Wall Street see this 205 into 2026, 31% upside. AMAT, buy, hold or sell. We then move on to Lowe's company, which is up 5% over the last year. Year to date, down 9%. Over the last 10 years, another outperform of the S&P, up 223%, trading near their 52-week low with just one buy rating from Wall Street. Now we see the forward P pretty much in line with the average. That is a reasonable signal, but the yield of 2.1 does sit above the 5-year, so an undervaluation one noted here. And we can pretty much see here again, pretty much bang in the middle, so reasonable signal again. Now we notice green right across the board, as you already know by now, something we love to see, with January 2027 numbers trading at a forward valuation of 16.9. Now growth isn't looking too great, but again, this isn't a company that is trading at a severely high valuation. We notice here down 3% year on year, flat moving forwards, and the sector not great, but still in the low single digit positive. And as well, their own 5-year showing this isn't a company with massive amounts of growth every single year. In terms of earnings per share, expected to grow only 6%, given we do notice both sector and their own 5-year sitting a lot higher, but you could argue this may start to increase if we do enter into a recession. A lot more people may start to go back to the things we saw during COVID, and their profitability sits at the A+, gross margin 33%, below the sector at 38%, but pretty much bang in line with their historicals. Bottom line around 8%, that is above the sector at 4.5%, also above their 5-year at 8%. And in terms of looking at the cash generated, around 9 billion, not too dissimilar from their historicals, but well above the sector at 290 million. Now institutions hold 74% ownership with around 7 billion worth of selling, but they've been buying around 50% as much at 12.8, and we also notice the same to be said in the most recent quarter. In fact, if you want to go to a time where institutions were more bearish than bullish, that would be Q2 2023. Now in terms of the metrics, we do see the free cash flow growing, although maybe not as consistently as we'd like to see. A massive growth spurt anticipated into the next 12 months, with their sales growth, as we highlighted, actually decreasing over the last 2 years. Again, this isn't a company that is growing significantly over the longer term. Ideally, we want to see at least 3 to 7%. From a numerical basis as well, we can in fact see nearly 50% growth over the last 10 years. Again, though, we do notice not as consistent as one would like. Shares outstanding, though, very similar to Applied Materials, very aggressive over the last 10 years. Always love to note that from any company we're considering. And ROIC, absolutely phenomenal. Not only very high, but increasing from 10 years ago, where it was sitting at 22%, which you could argue is already very strong in its own right. Operating margin above the 12% and increasing, so nice to see those efficiencies. Free cash flow pretty consistently around that minimum 5% that we do like to note. And the net debt to EBITDA sitting around 2.6. We would like to see this start to trend a little bit lower, but for the time being, no red flag indicators. Now intrinsic value gets to $271, and if we are to use a margin of safety in the episode today, we can in fact see you're getting 15% up to 230, 20% not quite there yet. So for Lowe's company, 15% at least, in fact, sitting around 15 to 20. Wall Street themselves, $270 price target, 20% upside. And for those that want to see it at a larger MOS, at 2217, at 25,203. So give us your thoughts. Lowe's company, buy, hold or sell. And don't forget as always to sign up to the free weekly newsletter. Grab those spreadsheets, come and join us in the Patreon where we cover our weekly buys and sells. And as always, have a great day. We'll see you all on the next one.